What is up, guys? This is the Broke Executive, and today I'm going to be talking about the 5 best stocks that I think all beginning investors and dividend investors should be looking at and possibly get purchasing to start off their portfolio. Now, these companies aren't exactly unknown companies. They're actually fairly well known within the dividend community, and that's why I feel they make such great starter picks for people who don't really know what they're doing yet and they want to kind of get their feet in the water and just figure out what they're doing overall. That way, they don't have to take huge speculative risks and they're not buying some of these stranger dividend companies that aren't necessarily like the well-known ones. So I'm going to be talking about the 5 best ones to be buying for when you're brand new and when you're just trying to get started. So with that, let's just jump right in. So first of all, we're going to have an ETF. It's PowerShares Dividend ETF, or SPHD. I've talked about this one several times before. It comes up in my portfolio reviews every month because they do pay a monthly dividend. That's one of the reasons I feel this pick is, and this stock is such a great one for beginners, because you're able to see these dividends every single month, and it really helps you get a feel for being able to receive that paycheck, so to say. And the way this dividend is set up, it's supposed to have low volatility, so you're not going to be watching huge spikes. Ignore what's going on over here. That was March and everything. Other than that, this ETF is a very solid pick. They pay a nice dividend, and the low cost of this ETF makes it great for beginning investors because you're able to get a whole share much easier than looking at some of these other dividend ETFs available to you that are hundreds of dollars. If you look at its dividend yield, you can see it's 5.06%, and they pay out $1.84 per share per year. They do not have a payout ratio because this is a dividend ETF, unlike a dividend stock, so they don't have cash income to pay back out. They simply collect the dividends from all the companies they own, split it up among all the shareholders of this ETF, and pay it out that way. They have a dividend growth over 5 years of just shy of 11%. This is actually really good. It's something I like to see because that means the dividend will be growing consistently over time. Now, this ETF is only about 7 or 8 years old. It is fairly new, and that's why the dividend growth is such a small number. But in the long run, I feel this is going to be one of those great dividend ETFs to be holding. The second dividend stock on this list, we're going to be diving into the world of real estate with Realty Income. This is known as the dividend stock because they do pay monthly. They have such a consistent dividend, and this is one of the staples in many dividend accounts, especially in the real estate sector of the industry and within real estate investing. Their dividend yield is 4.34%, and they pay out $2.81 a share per year. Their payout ratio is fairly high at 84%. This is because with real estate trust stocks, so REITs, they have to pay out a minimum of 80% of their income after they pay debts. So you're going to be seeing higher payout ratios regardless of the REIT you look at. That said, this one has a growth of a little over 4% over the past 5 years, and they've been paying their dividend for 23 years, being able to raise it that entire time. This company tends to raise their dividend multiple times a year in smaller amounts, which isn't a huge deal, and it's very nice to be able to see that dividend growing over time. At its current price, it is a little bit more expensive than the ETF I just mentioned. However, Realty is by far one of the investors' picks in the worlds of dividend paying and real estate. The third we're going to be looking at today is AT&T, or T. This company is fairly well known. I'm sure many of you guys actually have AT&T as your cell phone and service provider. They do exactly what I just stated. They do cell phone service, as well as they also have other various companies. They do own HBO, so HBO Max is another form of their income. This stock, yes, it is down over 5 years. However, with the high dividend payouts they have and the way that they're currently restructuring their debt and working on paying off debt, this is going to be one of those great dividends to be holding on to over the long term. They currently pay a dividend of 7.21%, and which comes out to be $2.08 per share. This is, again, a fantastic dividend yield within the world. And you can see they only have a 65% payout ratio. This is slightly high for a dividend stock, but it's not alarmingly high. It's not like they're paying out everything they make in order to keep that dividend going. They do have a dividend growth of 2.09% over the past 5 years. This is a lower number, but that can be expected when you're looking at dividend yields in the 5 to 7% range. They do have a very consistent dividend payout, and they have been raising that dividend or keeping it the same for the past 20 years. And that's another reason why this company is just such a great pick for you to be getting into the world of dividend investing. All right, number 4 on this list is Johnson & Johnson. Now, this is the most expensive stock in this list, but hear me out for just 1 second, because Johnson & Johnson does a lot more than just the baby powder that you guys are probably thinking about. They do anything from Band-Aids to baby powder to even making the scalpels used during surgeries. Pretty much anything with a pharmaceutical use or a medical use, this company creates and sells to generate revenue for the company. This is another one of those fabulous dividend picks that investors love to see in portfolios, and this is one of the better returning investments over the past several years, especially within 2020 and everything that's been going on due to mask wearing and all associated with that. This company is currently working on a vaccine. They are not Pfizer, which is the current front runner, because they just had the news and everything going on with that. I'm sure you guys have read, seen, watched, and everything involved with the current progress of the vaccine. However, Johnson & Johnson is working on a vaccine as well, and they have already stated and been giving government contracts just like Pfizer has. So this isn't exactly one of those like, oh, well, why bother buying this company when that company also pays a dividend and is currently doing better. Johnson & Johnson is one of those companies that's been around forever and will continue to be around forever, because they just have such a wide net of products and services that they offer that it's hard to beat. They pay a dividend yield of 2.72%, which comes out to be $4.04 a share per year, and they have a payout ratio of 50.44%. This is right where you want to see those payout ratios. It means that only half the money that's coming into the company they're giving back out to shareholders, so they still have plenty of money coming in for research and development of new drugs and being able to expand and help maintain their current status as a dividend king. They have a 5-year growth rate of 6.32% and have been paying this dividend for almost 60 years. Stop and realize 60 years of dividend payments and growth is far longer than most people need to worry about their retirement. In 60 years, I'll be 80. If this company continues doing what it's doing, and God, I hope it does, but that's more than enough that you won't have to worry about, oh, well, what if the dividend goes away? What if it's not yielding enough? This company has such a great growth streak that it's one of those very solid and safe picks. And last but certainly not least, we have the company with the largest market cap of any U.S. company, and I'm pretty sure the world, at least in terms of tradable companies. Now, Apple does tend to be a growth stock, but they pay a dividend, so it counts. Of course, when you're talking about Apple, you got to consider everything they do, and they have so many different streams of income, not just the iPhone, not just a MacBook. They have found a way to generate revenue and generate growth in anything they do. So the Apple Watch, which this one isn't, to competing with Spotify, having Apple Music, they have laptops, they have phones, they even have a streaming service with Apple TV. This is a company that actually pays out very little compared to what they make in terms of a dividend, and that shows that there's plenty of room for growth. And over the coming years, many investors feel that Apple is going to be one of those companies with a very aggressive dividend growth. They currently only have a dividend yield of 0.71%, which comes out to 82 cents a year. Now, these numbers are adjusted post-split, so at the end of this month, I'm going to be getting my dividends from my 2 shares of Apple I own. You guys can see that in the December portfolio review that will be coming out the first weekend in December. So something to look forward to there. Make sure you're subscribed for that. You can also see their payout ratio is 20.83%. Like I said, this is very low for a dividend company, and they should be and most likely will be growing this at a fairly aggressive rate. You can see their 5-year growth is over 10%, and they've been paying this dividend consistently for 9 years. This is one of those companies that, which I have mentioned before in some of my previous videos, they are only at the beginning of their dividend growth phase. That's why their dividend yield is low. That's why their payout ratio is low. That's why their growth is such a small number in terms of years consecutively. And over the course of the next 10, 15, 20 years, I, as well as many other investors, feel that they're going to be able to continue this growth over the long term and be able to build it up to 2, 3, 4% of dividend yield. So that completes the list of the 5 best dividend stocks that I feel any young dividend investor should be looking into and buying into. Again, this isn't a hard and fast list. You don't have to only own these 5 companies. You don't have to own any of these companies. It really comes down to the companies you like and the companies you think are best for your portfolio, your risk level, and really what you're looking for. If you want to do all growth stocks, by all means, I'm not telling you you can. I'm not saying you can't. It's just these are the companies that I feel I had either gotten into sooner or I have more of right now. Over the course of growing my account, I will be buying into all of these companies more and watching their dividends grow over time. Now, say you don't really like SPHD or PowerShares dividend, you could be looking at another dividend ETF similar to it, like the Charles Schwab High Dividend or SCHD. They have a little bit better of a return on investment over the past 5 years. I don't know what it is off the top of my head, but it's definitely higher than SPHD. But they do have a slightly lower dividend yield as a result of that. Say you don't want to get realty income, you'd rather find a cheaper real estate ETF or stock, I should say, in this case. You could be looking at companies like Stag Industrial or Store Capital. Both have much cheaper stock prices with around the same dividend yield. They just don't have that consistent growth. If you don't want to do AT&T because they've been losing money over 5 years and they have such high debt, you could look into something like Verizon. They also have a very good dividend, a very good yield. They've been growing it just not quite as long as AT&T. So like I'm saying, you could choose Microsoft over Apple if you're looking for the dividend growth stock pick. There's so many different companies out there that it's hard to say there's only 5 you need to own. And these are just 5 I feel fit best with young investors. But of course, you can always switch and pick and choose whichever ones you'd like. There's really no hard and fast rule to companies you have to invest in for any dividend or any investing strategy. The most important thing when you start investing is to actually start and invest. So if you'd like to get your investing jump started, you can sign up for Robinhood with the link below. You can get 1 free stock when you sign up, or you can sign up for Weevil, deposit $100, and you can get 2 free stocks valued at minimum $8 each, all the way up to $1,600 each. This would be able to explode your account and really just get you started on that dividend investing. If you have any questions about the companies I mentioned, or you feel there were companies I left out, feel free to leave a comment below, or you can hop over to the Broke Executive subreddit. I have a link for that in the description as well. Feel free to follow me on Instagram. I have the Broke Executive Instagram also linked in the description. I tend to post teaser, screenshots, posts right around Wednesday when I'm filming these videos so that you guys can kind of get to see what I'm going to be recording. And sometimes I'll play a little game asking, what company do you think this stock chart lines up with? Or sometimes I just give a heads up like, hey, as mentioned, I'll be talking about my biggest loser. It's this company. So feel free to follow me on Instagram just so you can see what I'm coming up with and what videos are going to be coming out so you guys can know ahead of time. And with that, I'm going to ask you guys to like and subscribe to my channel. And with that, I will see you executives in the next video.